Accounting for Merchandising Activities, Chapter 5. Learning Objectives. Describe merchandising and identify and explain the important income statement and balance sheet components for a merchandising company. 2. Describe both perpetual and periodic merchandise inventory systems. 3. Analyze and record transactions for merchandise purchases and sales using a perpetual system. 4. Prepare adjustments for a merchandising company. 5. Define, prepare, and use merchandising income statements. 6. Calculate gross margin and markup on inventory cost. 7. Record and compare merchandising transactions using both periodic and perpetual inventory systems. So we won't be doing periodic. 8. Explain and record provincial sales tax and goods and services tax and harmonized sales tax. That's Appendix B. We won't be doing that one either. Vignette video. Mountain Equipment Co-op started in 1971 and is Canada's leader in outdoor merchandise. With the need to replenish stock in a timely manner, the Perpetual System allows the company to have up-to-date records. Their 2017 sales totaled $465 million. Since opening almost 50 years ago, they have contributed $37 million in community investments. They are recognized for their commitment to sustainable outdoor recreation and environmental issues. Inventory. Products a company owns for the purpose of selling to customers. It is often referred to as merchandise inventory. It's classified as a current asset. Merchandising activities. Merchandiser. A company buys and sells merchandise and products, e.g. a wholesaler or retailer. Wholesaler. A company that buys products from manufacturers or other wholesalers and sells them to retailers or other wholesalers. Retailer is a company that buys products from manufacturers or wholesalers and sells them to customers. Calculating profit for both a service and a merchandising company. Exhibit 5.1 shows the differences in profit for a service company and a merchandiser. Operating cycle. Exhibit 5.4 shows the cash cycle and the credit cycle. Merchandise inventory. Cost of merchandise inventory includes costs incurred to purchase the goods, shipping costs, other costs required to make goods ready for sale, merchandising cost flow. Beginning inventory plus net cost of purchases equals merchandise available for sale minus ending inventory equals cost of goods sold. Merchandise inventory systems. Perpetual provides an up-to-date record of the amount of merchandise inventory on hand, cost of goods sold to date. Periodic requires a physical count of goods to determine the amount of merchandise inventory on hand, cost of goods sold. Perpetual System-Example. Purchases. November 2nd, debit, merchandise inventory 1200, credit, accounts payable 1200. Purchased merchandise on credit. Purchase returns and allowances. November 5th, debit, accounts payable 300, credit, merchandise inventory 300. Purchase allowance, RE, debit memo dated November 5th. Purchase/sales discounts. A deduction from the invoice price granted to induce early payment of the amount due. Example, 210 net 30. That means you get a 2% discount if paid within 10 days. Otherwise, it's paid in 30 days. Perpetual System-Example. Purchase discounts. Assume the purchase of merchandise inventory on November 2nd was on the terms 210 net 30. Case 1, discount taken. November 12th, accounts payable 900, merchandise inventory credit 18, cash credit 882. Case 2, discount not taken. November 12th, debit accounts payable 900, credit cash 900. Perpetual Inventory System account balances after recording journal entries. Displayed is the T account for merchandise inventory with a final balance of 882 and the accounts payable T account with a final balance of 0. Mini quiz. Prepare journal entries for each of the following transactions. Assume a perpetual merchandise inventory system. October 6. Purchase 650 units of merchandise inventory at $5 per unit. The seller offered a cash discount of 2/10 net/30. October 8th. Returned 25 defective units and received full credit. October 10th. Paid the amount in full less the returned items. Mini quiz. October 6th, debit merchandise inventory $32.50, credit accounts payable $32.50. October 8th, debit accounts payable $125, credit merchandise inventory $125. October 11th, debit accounts payable $31.25, credit merchandise inventory $62.5, credit cash $3062.5. Identifying transfer of ownership. FOB shipping point, buyer pays shipping. Carrier. FOB destination, seller pays shipping. Ownership transfers when goods, FOB shipping point, leave the seller's warehouse. The transportation costs are paid by the buyer. And FOB destination, ownership transfers when goods arrive at the buyer's warehouse. Transportation costs paid by seller. Transportation charges, perpetual system. Seller, FOB shipping point / FOB factory, buyer pays shipping charges, ownership transfers when goods leave seller's warehouse. Goods with the carrier, buyer, FOB destination, seller pays for shipping charges, ownership transfers when goods arrive at buyer's warehouse. Perpetual system transportation. Shipping costs on purchases are called transportation in or freight in costs. When a company pays for the shipping, the cost principle requires it to be part of the cost of inventory. Example, November 24th, debit merchandise inventory 75, credit cash 75. Perpetual system example, sales of merchandise. November 12th, debit accounts receivable 1,000, credit sales 1,000. Debit cost of goods sold 600, credit merchandise inventory 600. Customer payment. Case 1, customer pays in 60 days. January 11th, debit cash 1,000, credit accounts receivable 1,000. Case 2, customer pays in 10 days. November 22nd, cash $980, sales discount $20, credit accounts receivable $1,000. Sales returns and allowances. Inventory returned is not defective and can be resold. 2 entries. Debit sales returns and allowances 800, credit accounts receivable 800. Debit merchandise inventory 600, credit cost of goods sold 600. Sales returns and allowances. Inventory returned is defective and cannot be resold. Only 1 entry. Debit sales returns and allowance 800, credit accounts receivable 800. Adjustments, perpetual merchandise inventory. Perpetual merchandise inventory systems keep a running total of inventory levels by recording sales and purchase transactions. Periodic adjustments must be made to account for shrinkage, loss due to theft, or deterioration of merchandise inventory. Perpetual System Example. Inventory per accounting records, 21250. Inventory per physical count, 21000. Difference, shrinkage, 250. Adjustment required. Debit cost of goods sold, 250. Credit merchandise inventory, 250. Income statement formats. Income statements may be formatted in a variety of ways. Typical formats are multiple step, classified multiple step, single step. Classified multiple step format for internal reporting. Multi-step format for external reporting. Single-step format for external reporting. Gross profit margin. The gross profit in each dollar of sales may be tracked over time and/or compared to similar businesses. May be calculated for whole business departments and products. Gross profit margin equals net sales minus cost of goods sold divided by net sales. Markup on inventory cost. The average increase in selling price of a product over the cost. If a company has a set markup percentage, the selling price for a specific item can be calculated. Markup percentage equals selling price minus cost over cost. Or selling price equals cost times 1 times markup percentage. Review. Identify and explain the components of income for a merchandising company. The basic components of income start with net sales. From net sales is subtracted the cost of goods sold. The resulting amount is called gross profit or gross margin. Selling and general and administrative expenses are subtracted from gross profit to determine profit from operations. Review. Question. Explain the difference between single-step and multiple-step income statements. Answer. A single-step income statement format includes cost of goods sold as an operating expense and shows only one subtotal for total expenses. Operating expenses are highly summarized. A multiple-step income statement shows intermediate totals between sales and profit. It also includes detailed computations of net sales and cost of goods sold. Summary. 1. Describe merchandising and identify and explain the important income statement and balance sheet components for a merchandising company. 2. Describe both perpetual and periodic merchandise inventory systems. 3. Analyze and record transactions for merchandise purchases and sales using a perpetual system. 4. Prepare adjustments for a merchandising company. 5. Define, prepare, and use merchandising income statements. 6. Calculate gross margin and markup on inventory cost. 7. Record and compare merchandising transactions using both periodic and perpetual inventory systems. So we're just responsible for perpetual. 8. Explain and record provincial sales tax and goods and services tax and harmonized sales tax. That's also in the appendix that we're not responsible for. End of chapter.